Last week's headline wasn't just big, it was an explosion. 8.2% real GDP growth for India's July to September quarter. The number crushed the RBI's 7% forecast. We didn't just meet expectations, we smashed them by more than a full percentage point. The big question is the India boom finally back for good, or is it just a one time sugar rush? Keep watching, because in the next 6 minutes, we are breaking down the 3 hidden reasons for this surge. And more importantly, the 3 key dates that will decide if your portfolio gains another 15%. Let's unpack it properly. So, this didn't just happen by accident. 3 powerful forces all hit the economy at the exact same time. Low base, the rubber band effect. This is called the base effect. Last year, due to high interest rates and pre-election uncertainty, growth crashed to just 5.6%. Think of it like stretching a rubber band backwards. And when you let go, the immediate bounce back looks incredible. The math here is simple. A 5.6 base makes an 8.2% jump domestic demand. The village wallet wakes up. This is the real good news. Food inflation is almost zero, and crucially, the real rural wages are rising for the first time in years. This combination, plus GST cuts and a huge festive season, meant the private consumption, which is 57% of our GDP, jumped to 7.9%. This is the sign of a healthy, firing Indian customer. Exporters. The Trump tariff deadline rush. From October, the new 25% to 100% tariffs started hitting. Exporters knew this. So July and August became the last 2 free months. Companies shipped everything they possibly could: trucks, pharma, textile. This created a massive one-time factory surge that artificially pulled manufacturing and export activity forward. Let's look at the scorecard. Manufacturing, 9.1%, the star player driven by those massive export deadlines. Services, 9.2%, the backbone, led by banking, real estate, and professional services, which grew over 10%. Consumption, 7.9%, the foundation. Both urban and rural spendings fueled this. Investments, 7.3%, the heavy lifter. Crucially, this was the most government capex. Private companies are still shy. Agriculture, 3.5%, the lagging sector. Still struggling due to patchy monsoon. The summary. This was a broad-based party, but it was driven by 2 temporary forces: the export pull forward and the government spending. The reality check. Celebrate now? Yes. Get carried away? No. The good things. We are still the fastest growing large economy in the world by a mile. US is at 1.7% and China is 4.8%. It proves painful reforms, GST cleanup, PLI schemes, infra push are finally reaching critical mass. The fiscal problem. Nominal GDP, which is what the government collects tax on, grew only 8.7%. Why so low? Because inflation is near zero. Tax collections are growing way below the budgeted target. The export cliff. The export surge, it's over. Data for October and November is already showing a slowdown because the tariffs have now hit. The easy gains are finished. The shy private investor. Private companies are still not opening their wallets for big new factories. They need more clarity on the global trade outlook. So here is a final thought. This 8.2% was an amazing performance, but it was turbocharged by one-time effects. It is not yet the new normal. The market, with the Nifty already up 25% this year, is now in a prove it mode. It loved 8.2%, but it needs the catalyst for the next big move. 3 things investors are watching like hawks. Private capex. Will the Q3 results show big companies finally announcing massive new capital expenditure? We need private money to lead the next leg. India-US trade deal. This is the big one. If the US rolls back even 40 to 50% of those tariffs by December, January, the market will instantly discount a return to normal export growth. December 6th RBI meeting. Inflation is at historic lows. The market is pricing a 50 to 75% basis point rate cut. Cheaper money is equal to higher valuations. So watch it out this Friday. Let's summarize with a quick risk note. Yes, A US recession or new tariffs could cause a 10 to 15% correction, but strong domestic mutual fund flows means the floor won't break easily. The retail investor's playbook. Don't chase the index. Be a little picky at 24 times the earning. Start sipping into quality manufacturing, capital goods, defense, and private banks on every 5 to 7% dip. These sectors directly benefit from the government's capex push. The game changer. Huge news just dropped. PM Modi is opening the nuclear sector to private players for the first time, focused on small modular reactors. That $2.5 billion budget push and the atomic energy bill are a massive long-term opportunity for the manufacturing and capital goods plays. Keep 15 to 20% cash or liquid funds ready. The next big opportunity, the rate cut or the trade deal, will arrive suddenly. Alright, that's the full balanced story behind the 8.2% surprise growth. If you found this breakdown useful and learned something new, hit the like button now. Subscribe and maybe ring that bell, because the moment the December 6th RBI decision or the trade deal news drops, I'll be here breaking down what it means for your money instantly. See you in the next one. Keep smiling and thank you for tuning in.